What's up, investors? In this video, I'll be going through Alibaba and why I believe it may be a great addition to your portfolio. Alibaba is the third largest e-commerce company in the world by revenue and employs over 250,000 people. Based in China, this company has been consistently growing its revenues for the past decade. Alibaba manages various subsidiaries as well, including well-known names such as AliExpress and Tmall. At current levels, the stock offers a lot of value and is projected to experience consistent growth in the coming years. With a PE ratio of around 25, Alibaba is somewhat more reasonably priced compared to similar companies in the industry, like Amazon, which is sitting at a PE well north of 60. The stock is down almost 30% from its all-time highs, which may present the perfect opportunity to open a position. The company has a healthy balance sheet with a current ratio of 1.7, meaning it can cover its current liabilities with its current assets 1.7 times over. This ratio is an important indicator of whether a company can sustain itself in the short term, and based on its balance sheet, Alibaba is in the clear. Another important factor to consider when looking at a company's financial health is the debt-to-equity ratio. As you can see in the chart, Alibaba's equity has continuously increased throughout the years, while its debt has remained constant. This indicates that the company has had to rely less on debt for funding, with its liabilities now being well covered by operating cash flows. Alibaba has grown its revenues exponentially in the past decade, while its earnings have grown at almost 30% per year for the last 5 years. TipRanks puts the stock at a strong buy with an average price target of $301. That's derived from 25 buy ratings from different analysts and represents an upside of almost 40% in the next 12 months alone. Simply Wall Street also claims that Baba has a fair value of $307, which is in line with analyst price targets. In terms of future projections, Alibaba expects to do almost $280 billion in revenue by 2026. This represents a growth of almost 17% per year, while earnings are forecasted to be closer to 11%. Alibaba does, however, have a decent track record of beating earnings, so they may reach these numbers earlier than expected. Global e-commerce sales are also expected to continue increasing at a reasonable pace for the foreseeable future, so the company can capitalize on a growing industry. With 66% of its revenue coming from China, Alibaba can take advantage of the fast-paced e-commerce growth the country has seen. China has experienced significantly higher levels of e-commerce growth than the UK, US, and Germany. When observing the company's ownership, it's evident that institutions see a lot of promise in Alibaba, with over 47% of their shares being owned by institutions. Among the top institutional owners are BlackRock and Vanguard, two very well-known investment management companies. Overall, I see a lot of value in Alibaba's stock at its current price point. Down close to 30% from all-time highs, I see Baba making significant progress to close that gap within the next 12 months. It is, however, important to be aware of the risks as well when investing in foreign countries. In April of this year, Alibaba was fined $3.6 billion for supposedly abusing its market dominance. Ultimately, this was more of a slap on the wrist for the company, and they are expected to make a swift recovery from the loss. That being said, investing in a company from a country like China always poses additional regulatory risks from the government. If that risk is worth the potential reward is ultimately up to the investor. Thanks for watching, and I hope you found this video helpful. Feel free to leave a like and subscribe if you enjoyed, and I'll see you in the next one.